Hi, this is Yashashvi Choraria from BCom ANF 3A. My topic for today's management accounting assignment is going to be ratio analysis. So let's begin with the PPTs with the basic definition of ratio analysis. It is a quantitative procedure of obtaining a look into a firm's functional efficiency, liquidity, revenues, and profitability by analyzing its financial records and statement. It is of various types based on the profitability ratio, solvency ratio, liquidity, turnover, earnings ratios. The first one is a gross profit ratio, which is it represents the operating profit of the company after adjusting the cost of the goods that are sold. The higher the GP ratio, the lower the cost of goods sold and the greater satisfaction for the management. The formula for GP ratio is equal to gross profit divided by net sales into 100. The very next one is the net profit ratio. It represents the overall profitability of the company after deducting all the cash and no cash expenses. The higher the net profit ratio, the higher the net worth and the stronger the balance sheet of the company is. Net profit ratio formula is equal to net profit divided by net sales into 100. The next one is the operating profit ratio. It represents the soundness of the company and the ability to pay off its debt obligations. The formula is EBIT divided by net sales into 100. In current ratio, it represents the liquidity of the company in order to meet its obligations in the next 12 months. Higher the current ratio, the stronger the company to pay its current liabilities. However, a very high current ratio signifies that a lot of money is stuck in the receivables that might not realize in the future. The formula is current assets divided by current liabilities. Debt equity ratio represents the leverage of the company. A low debt equity ratio means that the company has a lesser amount of debt on its book and is more equity diluted. A 2:1 ratio is an ideal debt equity ratio to be maintained by any company. The formula is total debt divided by shareholders' funds. Interest coverage ratio. It represents how many times the company's profit are capable of covering its interest expenses. It also signifies the solvency of the company in the near future, since the higher the ratio is more comfortable for the shareholders and lenders regarding servicing of the debt obligations and smoothing function of the business. The formula for interest coverage ratio is equal to EBIT divided by interest expense. The quick ratio. It represents how cash rich is the company to pay off its immediate liabilities in the short term. The formula is cash and cash equivalents plus marketable securities plus accounts receivable, whole thing divided by the current liabilities. Financial turnover ratio formula is equal to net sales divided by average fixed assets, and it represents the efficiency of the company to generate revenue from its assets. In simple terms, it is a return on the investment in fixed assets. Inventory turnover ratio. The inventory turnover ratio represents how fast the company is able to convert its inventory into sales. It is calculated in days, signifying the time required to sell the stock on average. The average inventory is considered by this formula since the inventory of the company keeps on fluctuating throughout the year. The formula is cost of goods sold divided by average inventories. Profits earning ratio, PE ratio. It represents the earnings multiple of the company. The market value of the shares based on the PE multiple. The higher the PE ratio is a positive sign for the company since it gets the high valuation in the market for M&A opportunities. PE ratio formula is equal to market price per share divided by earnings per share. Earnings per share is monetary value of the earnings per outstanding share of a common stock of a company. EPS is equal to net income minus preferred dividends, whole thing divided by weighted average shares outstanding. Now let us look at a basic sum with all the given formulas and the ratios which were provided to us. In this particular sum, we have got current ratio, liquid ratio, stock turnover ratio, gross profit ratio, net working capital, debtors collector period, fixed assets turnover ratio, fixed assets shareholders net worth, reserves and surplus to the capital. So let us begin with a basic calculation. First we need to calculate the working capital, which is current assets minus current liabilities. Then we get to know the current assets and the current liabilities by the data provided. Liquid ratio is equal to liquid assets divided by current liabilities. With this we get to know about the liquid assets. Stock turnover ratio, gross profit ratio are given based on the formulas. Then we need to figure out gross profit percentage, and the sales. Average collection period is equal to 12 divided by debtor turnover ratio. Debtor turnover ratio is given in the formula. Fixed assets turnover ratio is equal to cost of sales divided by fixed assets. The next is a fixed assets to shareholders fund is equal to fixed assets divided by shareholders funds, where the shareholders funds is given in the data. Reserves and surplus is to be found out using the data. With all the given data and results, we have to apply them in the balance sheet. In the liabilities side, we put in shareholders funds, share capital, reserves and surplus, current liabilities and non-current liabilities. In the assets side, we put in fixed assets, stock, average account receivable. With all the given data and the numbers, we get a total of 11 lakh as a balance. Thank you for this seminar.